Welcome to this week's edition of Market Outlook. I'm your host, Derek Taylor, also known as DT. Market Outlook is a weekly podcast where I take a look at last week in the market as well as previewing the week ahead. I will also share with you some potential options trades that I'm thinking about for this week. So this past week, some of the news, one of the biggest stories was that most of the big megacap tech stocks reported earnings. You had Apple, Amazon, Meta, Microsoft, and many others report earnings this week. Amazon and Apple, they reported strong results and both stocks rallied a little bit. Meta fell sharply on increased spending plans, and Microsoft saw a bit of a dip after their tough earnings report. The market also reacted to a meeting between U.S. President Trump and Chinese President Xi, where Trump agreed to reduce tariffs on Chinese goods, while Xi he pledged to work with the U.S. on curbing the deadly fentanyl crisis. Stock market also reacted to Federal Reserve commentary, with Fed Chair Powell and other officials signaling caution, causing traders to pare back bets on a December rate cut. Powell was, he's always one of these guys. He comes out here and says, hey, don't bake in future rate cuts, right? He's always warning, hey, whatever it is you think we're going to do, we may not necessarily do. Well, this time he was doubly so, right? He really was trying to push home, hey, that quarter-point rate cut you think is coming in December, it might not come. And he was very strong in his wording on that. So that did cause the market to decline a little bit, especially on Wednesday afternoon leading into Thursday. Despite that midweek volatility, though, the major indices like the S&P 500 and the NASDAQ 100, they did end the week on a positive note, mainly buoyed by those big tech earnings. So let's take a look at the charts for the big index products. So let's take a look at SPX for the week. So the S&P 500 index finished the week essentially unchanged. It actually finished the week down about 0.1%. You can see this candle here was the Monday open, this green candle here, where we had a huge gap up, right? So one of the things, we started the week like gangbusters. We had a really big gap up on Monday, and then we had some strength on Tuesday and on Wednesday, and then Powell spoke on Wednesday. And, he starts poo-pooing a little bit the fact that, hey, you may not get a rate cut in December. The market sold off a little bit on Wednesday and definitely sold off hard on Thursday. And then Friday, we had a bunch of chop on Friday, up and down. And we ended up finishing the week about where we opened on the SPX. But for the most part, I would still say it's a positive week because we started on Monday with that big gap up. So even though we didn't go anywhere after the big gap up, it was still a positive week in the SPX. The NDX was even stronger because obviously the NDX is the tech-heavy NASDAQ 100, also had the big gap up, but then buoyed by especially those strong earnings with Amazon and Apple. And of course, Amazon and Apple have big weighting in the NASDAQ. The NDX actually finished the week up 1.5%. If we take a look at the Dow Jones Index, the DJX, you can see that the Dow 30 also finished the week on a positive note. The DJX was up 0.3% on the week. Now, you should note that the Dow, it's only made up of 30 stocks, and a lot of those 30 stocks did report earnings this week. Both Amazon and Apple are part of the Dow, so that obviously helped. Microsoft is also part of the Dow. Microsoft sold off, though. You also had Boeing, Caterpillar, I think Visa, and Honeywell all reporting earnings, and of course, those are all part of the Dow 30 as well. Now, the one index product that did show some weakness was the RUT, R-U-T, which is the Russell 2000 Index. It started the week on a positive note, but it sold off pretty much the first 4 days of the week, rallied a little bit on Friday, but some pretty extreme weakness Monday through Thursday. The RUT actually finished the week down nearly 2%. So that was, a little bit of a divergence from the small caps versus, of course, the large caps that are part of the S&P 500 and the NASDAQ. The VIX, which is the volatility index of the S&P 500, the VIX actually had a little bit of an uptick in the week. The VIX finished the week up about 11%. You can actually see the last 5 candles here. So this was Monday. We had very low volatility because the market gapped up. Typically on big up days, volatility comes crashing down, right? But, as the week progressed, as we got into earnings, the Fed rate decision, the meeting between Trump and Xi, volatility started getting pumped into the market, and we had a lot of volatility pumped into the market, especially on Friday with VIX closing the week at 1744. VIX started the week trading around 1574. So again, a really big uptick in volatility for the week. Now, is that uptick in volatility, is that a sign of troubled times ahead? Why is some of this volatility being pumped into the market? I think a lot of that has to do with the Fed rate decision, as far as the upcoming December Fed rate decision is now. Will it happen? Won't it happen? Who knows? Jerome Powell kind of threw a little bit of volatility into the market. We also still have some big tech earnings coming up this week. So naturally, volatility is going to creep up a little bit as you get some more big companies reporting earnings this week. But for us that are traders, if you're an active options trader, especially if you primarily sell options like I do, having a little bit of increased volatility in the market is not a bad thing, because now there's more opportunity, right? Because of the increased volatility, you'll get more money. You'll get a bigger premium for selling puts and selling strangles. So let's take a look at some of the sectors. So when we talk about market sectors, what is the one that really drives the market? It's mainly tech, right? What really drives the S&P 500 and the NASDAQ? It's tech, right? If the S&P 500 and the NASDAQ are up, tech had a good day. If the S&P 500 and the NASDAQ 100 are down, tech's having a bad day, right? That's just the way it works. That is the main driving force. Now, if we take a look at the tech sector for the week, tech had a pretty good week. XLK, which is the tech ETF, the tech sector ETF, that finished the week up about 1%, and of course that helped the SPX and the NDX finish positive on the week as well. The only other sector, oddly enough, that had a positive week other than tech, XBI, and that's not really odd, because if you take a look at a chart, I've mentioned this every week on this podcast, is XBI, the biotech sector, has just been insane for the past 6 or 7 months, just up, 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 straight to the moon. Now, why is XBI having such a good time, especially here in the last week? Well, I think that was primarily due to a surge in some merger and acquisition activity. There were some major deals with some drug companies. I think Novartis was acquiring Avidity Biosciences. Now, that particular stock really didn't have a crazy week, but I think the larger picture is that there's a lot of merger and acquisitions going on right now, and that trend, I think, is helping some of the large pharmaceutical companies that are seeking to replace some of their revenue, especially as drug patents expire, and a recent focus on clinical stage assets is further boosting confidence in this particular sector. Overall, XBI finished the week up 2.5%, really big week. Every other sector in the market was down, so it really was a market that was driven by tech this past week. Now, on the downside, certain sectors were weaker than others. XRT, the retail sector, had a nasty week. It was down 5.5%. If we zoom in here, for those watching the video version of the podcast, we'll take a look at the last 5 candles here. So we started the week around 85.5. We finished the week at 81. Other sectors that had a rough week included XLRE, that's the real estate sector ETF, had a really nasty week. For those watching the video, the chart looks very ugly. You can see real estate finished the week down a little more than 4%, and in a similar vein, XHB, which is the home builder sector, kind of related with real estate, right? Also finished the week down nearly 4%. XHB finished the week down at 3.9%. Now, why are home builders and real estate having problems? Well, I think that was just the broad macroeconomic picture, especially that cautious Federal Reserve stance on the future interest rate cuts. That's going to weigh down real estate and home builders. Why was XRT, the retail sector, kind of weak? Well, I think that has a lot to do with just economic reports. There's a bit of a sign that there is some slowdown in consumer spending, and of course that's going to hurt the retail sector more than most other sectors. Another sector that would be affected by consumers spending less would be consumer staples. So if we take a look at XLP, the consumer staples ETF, you can see, very nasty week. Looks very similar to the XRT chart, right? Consumer staples finished the week down 3.8%. So let's talk a little bit about last week's earnings, because we did have some major earnings events. The biggest one, as far as the one that really helped drive the market higher. Amazon. Amazon beat earnings expectations with its cloud division, AWS, showing strong revenue growth. And of course, you never know whether a strong earnings report is actually going to send the stock higher or not. A lot of times, the stock does not move with the earnings report. A company, I've seen many times, company reports great earnings and the stock crashes, or they report the worst earnings they've ever had and the stock goes up, because the market just doesn't react to earnings. Like if it's a good earnings, I'll go buy it. If it's a bad earnings, I'll sell it. And that's not the way, humans are not rational creatures, and humans, especially traders, we're always just trying to make money. We don't really care what the earnings report is. We just want to make money. And that's why you sometimes get a stock that doesn't move exactly the way you think it will on earnings. But with Amazon, yeah, they reported strong earnings and the stock had a huge gap up. And you can see on Thursday, the last price on Thursday was $226 and they opened on Friday at $250. So just a gigantic move, and a very large company, because Amazon has a market cap of $2.6 trillion. You don't see a $2.6 trillion company make a 10% move very often, right? And obviously when you have that large of a company make that big of an increase, in gains, that is really what helped push the SPX and the NDX higher last week. Another earnings event that happened last week was Apple reported earnings the same day as Amazon, and this is their Friday candle. They opened higher, they gapped up and then sold off later in the day. Overall, though, Apple finished the day down about $1 the day after earnings. It was really kind of a non-event. So Apple really didn't go anywhere. Now, Apple, they did top their expected earnings and revenue forecasts, so their earnings were fine. A company that didn't have great earnings was Meta, though. So Meta saw shares drop significantly after the company announced plans for increased capital expenditures, signaling a potential need for more debt to fund its AI initiatives. So, that market did not like that, right? So Meta saw a drop. Well, we can actually see here. So they closed on Wednesday at 751, and then on the opening bell the next day, they opened at 668, right? Just a gigantic, like a 80, 90 point drop, right? Now, Meta was a $750 stock, so a $750 stock dropping about 80 or 90 points. Not the end of the world, right? But it was a significant move. If you were playing Meta for earnings, you probably got hurt. Unless you were playing it purely directional as a bearish trade. If you were doing a neutral trade like a strangle or an iron condor, you probably got murdered on the trade, right? If you were doing like me, I was being bullish and I did an out of the money put credit spread. That didn't go well, right? Although I'm fighting the trade. Matter of fact, I can show you the trade. I go to my positions tab here. I'm in a put credit spread. Now this was in the 50-day cycle going into earnings, and then Meta dropped significantly to the point where the put credit spread I had on was in the money. So what I did is I rolled out to the next month, made it a 76 DTE trade, which helped finance the roll. I also rolled it down in price, get the strikes further out of the money, which I would have had to pay a debit for. But in order to overcome paying the debit, what I did is I made the strikes wider. So this started life, if I go to the charts here, I go to the chain, this started life as like a $5 wide put credit spread that went against me. So I woke up one day, after earnings, and now all of a sudden I'm in the money, slightly in the money on this put credit spread, this $5 wide put credit spread. But I rolled it out a month, which gave me a little bit of a credit to help me move it down. But I could only move it down so much. So to make the roll bigger as far as a credit, so I could, actually roll further out of the money, instead of a $5 wide put credit spread, I rolled to a $10 wide put credit spread, which makes the trade twice as big, right? It adds more size to the trade, but I was really small going into the trade. So I could do this. If you were already really big going into the, you already at your max size as far as your position size, you would not want to add to a losing trade. But because this was a small trade to me, I doubled the size by making it a $10 wide put credit spread to finance that roll. So I'm still in the trade, and I feel okay about it. We'll see where the trade ends up 76 days from now. But for now, I'm in the trade. I'll hold on to it for the next couple of months and see what happens. And the last big mega cap tech stock that reported earnings this past week was Microsoft. Microsoft did, it went down on earnings, right? It had a little bit of a down move, but it wasn't a gigantic down move. It wasn't a meta move, right? So Microsoft was a little weak after earnings, but had you done a delta neutral strangle or an iron condor, you were probably okay on that trade in Microsoft because it didn't move outside the expected move. For me, I don't remember what I did in Microsoft. Did I actually put on an earnings trade? Let me see. Yeah, I put on an iron condor and it went nowhere. So I can tell you what the iron condor did. It didn't do anything, right? You didn't make money. You didn't lose money. It was basically a non-event had that been the way you played it. One other notable big tech stock we should talk about, Netflix, which had earnings the previous week. But the big story this week was they announced that they're going to finally do a split. They're going to do a 10-to-1 stock split because the share price is $1,100. It makes it practically untradeable. They're really illiquid as far as the options, the really wide bid-ask spreads. It's just, when stocks get more than, say, $200-300 a share, liquidity tends to dry up. Once they get above $500 a share, they become very tough to trade. And in this case, trading at $1,100 a share, yeah, this really needed to do a 10-to-1 stock split. So I'm glad that's going to make trading Netflix a lot better. You're going to see a lot more people now. Probably you're going to see 10 times as many people trading Netflix now as what was trading there previously, just because of, now it's a much more manageable share price, much more manageable bid-ask spreads. A couple of other stocks I want to mention because I have positions in them, so I mention them every week here lately. Let's take a look at the quantum stocks, specifically Rigetti and IonQ, because I have covered strangles on in both. Rigetti actually had a pretty good week. Had a really good Thursday and Friday this past week. Rigetti finished the week up about 12%. You can see it finished the week trading at 44.36. Now, I have a cost basis of 47.40 on my shares. I'm down slightly on the shares on the covered strangle, but you know what? I'm hanging in there. I'm in the neighborhood there. IonQ, though, this cover strangle in this has not gone well. I'm well underwater as far as my cost basis on the shares in IonQ because I've got a cost basis of nearly $80 a share. IonQ finished the week trading at 62 and change. Overall, though, as far as a 5-day week, IonQ finished the week basically unchanged, down maybe 1%. As far as where it opened on Monday and where it closed on Friday. Very similar as far as the open on Monday and the close on Friday. We'll essentially say IonQ finished the week unchanged. Overall, though, I'm going to hold my positions in these quantum stocks. I still think they will eventually start trending back upwards. The dollar had a really good week this past week. If we take a look at UUP, which is the dollar index ETF, the dollar index was strong, finished the week up 1.1%. Now, if the dollar is strong, that means it's strong versus the other currencies. If we take a look at 6E, which is the Euro futures, you can see the Euro futures had a really ugly week, especially Wednesday through Friday. 3 big red candles in the Euro, and the Euro is the big component of the dollar index. It's the dollar versus the Euro. That's more than half, I believe, the weighting of the dollar index. The other big component of the dollar index is the Japanese yen, which has had really 3 or 4 nasty weeks, including this past week. Very similar to the Euro, had some big red candles on Wednesday, Thursday, slight down day on Friday. For those of you playing the bonds, let's take a look at TLT for the week. This is the 20-plus year Treasury Bond ETF. TLT, you can think of this as the ZB futures in ETF form, right? And it was a bad week in the bonds. The bonds finished the week down 1.1%. Now, crypto, on the other hand, finished the week really weak because I'm not playing the bonds, but I am playing crypto. If we take a look at IBIT, which is the Bitcoin ETF, right, your spot Bitcoin ETF, it had a little bit of a choppy week, but even with all the chop, it finished the week down 4.7%, a really nasty week in Bitcoin. For those of you playing Ethereum, you had an even rougher week. If I can type the symbol for ETHA, which is the Ethereum ETF. Ethereum finished the week down 6.8%, so down nearly 7%. And just briefly, for those that are wondering what I'm doing in IBIT, the Bitcoin ETF, I have a strangle. I have 2 puts versus 1 call, meaning I'm leaning quite a bit long, and I'm leaning quite a bit long because the stock has moved against me, right? I'm also leaning quite a bit long is because I want to lean long. IBIT has sold off so much. Bitcoin has seen such a sell-off. I've got to lean long. I would never lean short here, right? So I'm purposely leaning long in this 2-to-1 ratioed strangle. Now let's talk about some of the earnings this week. So we have a lot of earnings this week. So before the bell on Monday, Berkshire Hathaway and ON Semiconductor report. Now, if you wanted to play those, you would have had to put on a trade Friday this past week. So if you're not already in a Berkshire or a ON Semiconductor trade, you can't play it for earnings, but they will report before the bell on Monday. After the bell on Monday, we have Palantir and HIMS. I have positions on in both Palantir and HIMS, or do I? Actually, I'm looking at my positions tab. No, I took them off. I think I took them both off on Friday, knowing they would both report after the bell on Monday. I just went ahead and got my positions off the books, but I did have positions on in both Palantir and HIMS. And I may or may not play them for earnings. I didn't want to play them with the positions I had on, though, especially the Palantir trade. I had a strangle on that I really wasn't comfortable holding through earnings. Further earnings through the week. Before the bell on Tuesday, we have Uber, Shopify, Spotify, and Pfizer report. And then after the bell on Tuesday, we have AMD, Supermicro, Marathon, Upstart, and Rivian. Before the bell on Wednesday, we have Novo Nordisk and McDonald's report. After the bell on Wednesday, we have really a lot of tech stocks. We have Hood, AppLovin, IonQ, Qualcomm, ARM. We also have Lyft reporting after the bell on Wednesday. Before the bell on Thursday, we have Celsius Holdings and QBTS, which is the D-Wave quantum computing stock. And then after the bell on Thursday, we have a lot of meme stocks. We have Open and IREN, IREN, MP, which is the materials company, the one that's been in the news because of all the U.S.-China talks. We have SoundHound. And then we have some real companies that are interesting, the Trade Desk, Airbnb, and DraftKings. And I mentioned DraftKings because for those of you that follow sports, there has been some sports betting scandals come out here in the last couple of weeks involving some NBA players and coaches that were involved in some illegal betting activity and point shaving, as well as involved with the mafia in illegal poker tournaments. Like, there's some weird stuff going on, right? And I mentioned that because, a lot of that stuff is tied to sports betting, right? It's how these sports leagues are in bed with the sports betting companies, the casinos, like DraftKings. And, it's just interesting to see where that stock goes after the bell on Thursday. I don't know if I'll play it or not, but I might. And then before the bell on Friday, we have CEG, which is Constellation Brands, and WEN, that's Wendy's, the fast food joint. Now let's talk about some potential trades for this week. What am I looking at to play this week? Well, I mentioned Palantir is going to report earnings, and I had a trade on, I had a strangle on that I didn't want to play. So let's take a look at Palantir. Well, if I can type the ticker symbol correctly. Palantir, you take a look at its stock chart, right? It's always up and to the right. So it's just going up, 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 up. And it's been okay trading it with strangles, even though it tends to go up. A lot of times I lean a little long, but holding a strangle through earnings, I would be very worried about holding that naked short call on a stock that just goes up all the time. I don't know. This thing could have an Amazon kind of move and gap up 10%. That would really hurt a naked short call that's part of a strangle. So I took that off. What I'm thinking about putting on Monday is to just be bullish in the trade. So what I'm thinking is I'm going to go sell an out of the money put, way out of the money put, because Palantir got a lot of IV. You can get some really juicy premium. Right now, the IV rank in Palantir is 34. The IVX is 68%. I can go sell the 10 Delta put in the 48-day cycle for $2.82. Nearly $3 credit on a buying power reduction of only $1,500. And I'm $50 out of the money right on that trade. So really safe trade, and because it's a naked short put rather than a naked short call, if something crazy happened, if Palantir dropped 60, 70 bucks after earnings, which would be just a monster move, like it'd be a crazy move. But should that happen, Would I hate being assigned 100 shares of Palantir at $150 a share? Well, really $147 a share because I'm getting about $3 credit. So 147 would be my cost basis. Palantir is trading at $200 a share now. Would I want it at $147 a share? For me, yes, I would love to have it at that share price should that happen. So that's the way I'm thinking about Palantir, is just selling a 10 delta put 48 days out. If the trade goes way against me, I can always take shares, but chances are you're going to win on this trade because the pop on the trade's 88%. The P50 number, and I always manage my trades at 50%, it's 94%. You're going to win on this trade, 50% max profit, 94% of the time. Great risk versus reward on the trade. All signs point to go on that. Another earnings trade I might take this week. Uber. I often play for earnings. Uber has an IV rank of 34, has an IVX of 44% in the 48-day cycle. So if I go into the December monthly cycle, what would I do in Uber? Well, it's got decent IV, and because it's got decent IV, I think I just do one standard deviation strangle. Go about 15 deltas on each side. In this case, I'll sell the 82.5 put and sell the 115 call. Now, Uber reports before the bell on Tuesday, so yeah, I probably put this thing on first thing on Monday or maybe later in the afternoon on Monday if I'm worried about Uber making a move Monday morning. But this is where it's, about where it probably will be trading. And assuming that this price is accurate on Monday morning, I'll get about $2.35 credit on a 15 delta strangle on a buying power reduction of just under $1,000. Great risk reward. Uber, I don't really worry about making a crazy move. It's not as volatile as Palantir. If you take a look at the stock chart with Uber, it's got a lot of two-sided action, a lot of chop. Kind of been trading in a nice little range here in the last few months. So for me, I think the strangle makes a lot of sense playing that for earnings. Another interesting trade for the week, GDX, for those of you that are in the gold miners ETF, I've already got a position in this. I am in a strangle, I believe. Let's see. Yeah, I'm in a strangle. 2 puts versus 1 call. So I'm leaning long purposely. What I was thinking is this has been a tough trade for me, and one of the things you can do when you're in a tough trade, find something that's correlated to it and maybe take the other side of the trade or trade it in a different way. If I already got the GDX position, maybe do a Newmont mining position, NEM. Newmont Mining is the largest gold mining company. It's the largest component of GDX. And, if I wanted to trade this, you can see its stock chart looks a lot like GDX. If I wanted to trade Newmont, I would need to do something different, right? Maybe instead of leaning bullish, maybe lean a little bearish in this. Or maybe, since I'm already leaning a little bullish in the strangle in GDX, maybe do a purely delta neutral strangle in Newmont Mining. I mentioned this not necessarily because I necessarily want to take this trade, but I know a lot of you guys are in GDX positions. You're playing the gold miners ETF. You have for a while because of the crazy move in gold all year, right? And a way to sometimes hedge a position is go find something very highly correlated to it and put on a different position. If you're in a naked strangle in GDX, maybe go put on a defined risk trade of some kind, maybe directional in NEM. Do a call credit spread or a put credit spread, or do something a little different. Have a bunch of different positions with different directional assumptions, all in these correlated products. That way, when things don't go your way because you have several different trades on, you'll profit on some, you'll lose on some others, but in the end, hopefully you get some good two-sided action and you have a chance at some point to profit on all of them. And one final trade I want to mention as far as a trade idea I'm thinking about, one of the big mega cap tech stocks that reported earnings this week that I haven't talked about yet, it was Google. I should have mentioned it earlier when I was mentioning Meta and Amazon and Apple. Google reported this week they had a really good earnings event as far as the stock gapped up in a big way, and then sold off a little bit afterwards. But Google retained some IV. The IVR in Google is still 30, which is about the minimum I want to sell options. IVX in the 48-day cycle, 37%, so decent IV still in Google. How would I play Google? Well, a lot of times, because it has decent IV, I might go sell a strangle. But because I'm worried, hey, is this momentum from the earnings event? Will it continue? Will we start seeing a big move up, or will it come crashing back down? Will people start taking profits and this thing move in a big way up or down? I don't want to get hurt on a strangle. Well, I still I still want to do the strangle, but maybe I want to hedge my bet a little bit. One way I can do that is with a ratio spread. In this case, let's do the double ratio spread. So what I want to do is I want to buy an out of the money debit spread, in this case a put debit spread. I'm going to buy this out of the money debit spread for $75, and I'm buying the 17 delta put and selling the 14 delta put. It's a $5 wide put debit spread I'm buying for 75 cents. I like that. As far as, I'm willing to give up that 75 cents on that side of the trade. Let's do something similar on the call side. So I'll go buy 17 delta call, sell the call $5 above for about the same price. Overall, I'm going to pay $146 debit for these two debit spreads, but I'm not going to pay a debit because I like the short put and the short call and double them. So now I'm selling two puts versus buying one put, and selling two calls versus buying one call. Overall, now I'm getting a credit on the trade, $380 credit for a buying power reduction of just under $3,000. Google is currently trading at $280 a share, so the buying power is a little high, so you're going to need a little bit of a bigger account. You're probably going to need, if you're trading at least with a $50,000 account or more, then this is a very doable trade. But if you're looking at the video, you've got the risk profile, this double ratio spread, sometimes called the Batman trade because the risk profile looks like a bat, right? As you get the two peaks on each side of the risk profile. But this is essentially a strangle where you've hedged your bets a little bit to the downside and a little bit to the upside with those debit spreads. You still have unlimited risk on both sides, but you have wider break-even points because of the embedded debit spreads that are a part of the ratio spreads. So that's this week for this edition of Market Outlook. Now, if you want to help support my work, if you haven't already checked out my book, please buy the book, The Super Wheel Option Strategy. This book is available on Amazon. If you're watching the video portion of the podcast on YouTube, you will find a link to that book in the show description. For those of you listening to the audio podcast, maybe you're listening on Apple or Spotify, please give the podcast 5 stars because we need that help as far as getting noticed in the algorithm. So if you're a fan of the show and want to help support my work in a little way, and it's not much, but hey, please click that 5-star button in Spotify. I think it'll help. Peace, guys.